Hey guys, and welcome back to the Young Investors Podcast. This is episode, I don't know what episode it is. What episode is it? 26.
I think.
And
yeah, 26.
Joining me as always, but not as always, in the studio is Brandon.
Woo! Hello!
Yes.
I'm here in Melbourne, live.
This is exciting. This is something we haven't done before.
Yes,
and
sick.
I mean, I've been looking forward to doing this for such a long time.
Yeah, I haven't really been looking forward to it.
No,
it's cool. It's gonna be. I think it's gonna be a more laid back feel today, but it's good.
Yeah,
it's good to be here in person in Melbourne. We're going to the footy tonight.
Yeah,
go the Tigers.
We've got a full day planned. Make some videos.
It's gonna get some lunch.
Yeah, it's gonna be.
It'll be good. Anyway, these people don't care.
Yeah.
Let's get into it, hey?
Yeah, sure. So we'll go through, of course, we're going through the same sort of structure as always. We'll start with the indices, we'll go through some news, and in the main section, we're going to be talking about shares and property. So we're going to be comparing the two and sort of talking about the differences, the pros and cons, and sort of the conveniences of each of them. And then we'll go through some Q&As. We've got a few Q&As for
today. We've got a few. We'll see how we go.
Yeah.
Yep. Yeah, all right. Well, let's go through the indices first up. So this is since our last podcast. Our last podcast was with Sven 2 weeks ago. That was such a good podcast. That was so good. Yeah. I was so pumped. That podcast was epic. Anyway,
yeah, it was
Sven, come back on any time. We love you.
Yeah, absolutely.
So indices, Dow. So this is in the last 2 weeks. Dow was up 1.2%, NASDAQ up 4.3%. NASDAQ just far out, screaming away. S&P was up 2.9%, and in Australia, All Ordinaries down 0.6%, and ASX 200 down 0.6% as well. So not much happening as per usual in Australia, but
tech's up big.
Tech's gone crazy. Yeah. All right. Well, that's the indices. Very boring. Let's do some news. I'll hit us with the first news topic.
Yeah, go for it.
So first one, I actually got a comment specifically saying, please don't talk about this. So I'm going to talk about it. Tesla. Oh gosh, don't we love this company? They came out with their Model Y. So, and it's essentially like just a Model 3, but bigger. Yeah. And I think their stock dropped the day after they came out with it, dropped by like 5%. I'm going to look that up. But yeah, pretty crazy. Have you seen the Model Y?
I have, yeah. It looks very similar to the Model 3. It's interesting.
A little bit higher.
Yeah. I mean, I don't mind the design. I think it looks quite good. I mean, I think all of their cars look very good.
Yeah.
They've got sweet. Yeah, they've got design down very well.
Yeah. Franz von Holzhausen. He's got it down. Yeah,
he's the design guy? Oh.
Yeah. I like that their best design's the Roadster, the new Roadster. Have you seen that?
Yes.
Far out.
Yeah.
Flip and swish. But yeah, their stock's down. I can't remember when they released it. Was it the 13th? So their stock was at about 290 and now it's at 273. So it has tanked a bit. I was actually watching Galley's video about... he went to the event where they unveiled it. Yeah. And he actually said that if they don't do like a one more thing, then he reckoned the stock would drop quite substantially. And his mate thought that as well. And that's exactly what happened.
Oh, wow.
Because everyone just kind of wants these events to be like blow you out of the water kind of thing. So like everyone was just like anticipating, like last time they had the new Tesla Roadsters, the one more thing. So they're anticipating that, and then it just never came. Yeah. And they already knew, like people knew what the Model Y was going to be. Elon said it's like about 75% similar parts to the Model 3. Yeah. So it's just like they knew what it was going to be. They knew the specs of it. So it's just like, this is what it looks like. And everyone's like, hey.
Yeah, the expectations are so high now for their releases.
It's rough.
It's kind of reminds me of like the iPhone. I mean, like the first iPhone that came out, everyone was like, what? And now it's like... It's the same phone again for the fourth year in a row.
Look, it's a slightly smaller notch.
Yeah, we've done nothing, but give us another $200 on top of what you paid last year.
We've added a little bit of RAM, a little bit of memory, and the notch has gotten a little bit smaller.
And the battery life is worse.
Yeah, the battery life has not changed. It is the same. Yeah, no, that's true. But yeah, far out.
Yeah.
Tesla, I wouldn't mind if I got gifted a Tesla. Anyone out there that's super rich wants to give me a car?
My P.O. box is...
Yeah, my P.O. box. Send the car directly to my P.O. box. Anyway, so that's Model Y. We shouldn't talk about it too much. We've had very negative feedback about us talking about Tesla. Yeah. So we better move on.
We'll move on. We've got one more news story here, and it's about Boeing. So this was... I think a couple of weeks ago, but we haven't had the podcast for a couple of weeks, so we didn't get a chance to talk about it. But Boeing, of course, they've been in the news because their in-flight software in their new 737 MAX is being blamed for a number of crashes. There's 2 crashes. So most recently, I think it was on the March 10th, Ethiopian Airlines Flight 302 crashed due to sort of flight control software malfunctioning. Wow. Everyone on board was killed. It's 157. So that was quite devastating. And what sort of investigators realized is that the circumstances were very similar to a crash 6 months ago on a Lion Air flight, which was also a Boeing 737 MAX. And that one killed everyone on board, 189 killed.
Tough industry.
Yeah, and there was, for a while there, they were sort of talking about whether or not it had any, if it was just a coincidence, if it was Boeing's plane. But now they're starting to piece it together. In fact, the day before the Lion Air crash, there was another Lion Air flight where the plane, the in-flight controls malfunctioned, and they were able to save it by turning it off.
Far out. You turn the plane off. Take the key out of the ignition. We're coasting in now. Just turn it off. Turn it off. That's funny as. There you go. So actually they realize, wow, far out. Yeah, tough industry to be in when you're killing whole boatload or plane loads of people at once.
It is. And you always have these events and then you don't really think about the business consequences until it happens for the first time. But if you think about Boeing as a business, I mean, they already have a ton of liabilities on their balance sheet. Yeah. But a massive liability that's not on their balance sheet is if they do something like this and it kills people, and those people, their families sue the company. Yeah. That's a liability that's just going to poof. Yeah. It's just going to appear on the balance sheet.
And one thing that's interesting is that you think about the costs associated if they have malfunctioning like flight control stuff and they have to recall some like aircraft, and like aircraft costs like a lot of millions of dollars. Then that starts to be a bit worrying as well. I wonder if that's like what they have to do if there's malfunctioning flight control software. I guess that's just kind of like software though, so potentially that could be fixed without it's not like a hardware fault.
So that's probably the positive. One thing I heard, I don't know the exact number, but I believe it was in the range of 60 to 80% of the orders for Boeing planes are the 737 MAX. So the vast majority of the backlog of orders are for this plane.
Oh jeez.
So if it was a hardware problem, that would be seriously, that would be a serious issue, because a lot of planes would be like, we're not ordering this anymore.
But or if you had to recall the ones that already exist. I mean, is this a new model?
It's a new model.
It is. Oh, okay. So they wouldn't have to like recall them. Okay. The FBI is reportedly aiding criminal probe of Boeing 737 MAX certification. Jeez, it's just escalating from here. I'm going to look at the stock. Do you know how much the stock went down?
The stock is down about 16% from its high.
16%. That's
about 2 weeks ago. And it's a big company. 16% is a lot. I think its market cap at the moment is just over 200 billion.
Yeah. So, I wonder what the market cap of Airbus is. Because I think it's Airbus versus Boeing, and that's pretty much the two main players in the aerospace or
find out.
Aeroplane. Yeah, Airbus.
90 billion.
90 billion. What was this one?
Boeing 200. So Boeing's quite a lot bigger. Yeah. I mean, they're both huge.
Well, they're both facing problems because Airbus is, well, not really problems, but Airbus is stopping the production on their A380s as well. They're massive, massive ones. But I don't think that's a problem because they just weren't selling enough. So they're just like cutting what they don't want. Yeah, far out. Look at the Boeing share price. Just like, man, look, since, have you got it up? Yeah, since December last year, just like up like crazy.
Yeah, that's a crazy.
And actually, if you like bought your shares anytime before January this year, it's still up.
Yeah, it's insane.
Even with all of this,
it's been a crazy stock. It's been very loved. You see these kind of stocks. I mean, they're obviously great companies, but then they just sort of get on a roll to the point where they're just. People just buy them because they're a massive name and they, have this opinion that it's a great business, so at any price they can buy it, and you see that happen. You're seeing that happen with quite a lot of stocks.
Yeah, it's an interesting business. I don't think it will. It's hurt them like 16% or something. I don't think it'll hurt them too much because I reckon like they may not have like a standout moat, but certainly the barriers to entry in this, like in an aerospace industry is like huge.
Oh, absolutely.
So I don't think, well, really, if they haven't got, say the 737 Max is just like a flop.
Yeah.
Well, what are people going to buy then? They're probably still going to buy a Boeing 737, just not the 737 Max or an Airbus. Maybe this will give a big boost to Airbus. Has Airbus gone up? I don't know. But yeah, interesting.
Yeah.
So that's that news story. Do you have anything to add? Sorry, I cut you off there a little bit.
No,
You're
all good.
The last one that just caught my attention really is that there was a survey from, where is it? Griffith University Centre for Franchising Excellence. And they surveyed 1,816 either small business owners or franchise owners. And they essentially came up and asked them, is your small business or your franchise system, is this the worst decision you've ever made? And they divided it up. So they divided it up into franchises that had gone bankrupt and franchise systems that were successful, and also independent small business that was successful and also failed small business. So they asked them, is this the worst thing? The worst thing I ever did was buy this franchise or business. That's what they asked them. And from the people with the franchise, if you had a franchise that's still surviving, they agreed with that statement 60%, that was the worst thing they ever did. And then if it failed, that rose obviously up to 70%. But then if you look at small business, if they survived their small business, only 22%. And then if they failed, then it goes up to 30%. So we're talking like, even looking at the ones that survived, the worst thing I ever did was buy this franchise or business. Agree 60% from a surviving franchise, and 22% agree from a surviving small business.
That's insane. 3 in 5 people who started a franchise, even if it survived, said it was the worst thing they ever did.
Yeah. It's pretty... And I mean, this is why you've seen like all of the stuff going on with Retail Food Group as well, especially in Australia. They own like Donut King and Pizza Capers and Gloria Jeans, all these franchise systems. And there's so much crap coming out because the fees are just so high. These people are essentially kind of being conned a little bit into by REA Group saying, oh, you can earn this much money. Oh, by the way, the fees are like huge, and you have to exactly. So that's why you see REA Group, the shares of REA have gone down like crazy over the last couple of years. I mean,
with that one specifically, they were taking their royalty off the revenue. So that's a lot of these Gloria Jeans and Donut, what was the other one?
Donut King,
they weren't even profitable, but REA was profitable because they were taking the revenue.
Yeah.
And there was all these sort of, and then that led to underpaying staff, and there was all these other things that came out of it.
Yeah. It's pretty much just like shake my hand and run your business at a loss and give me a lot of money in the process.
Yeah,
it's like, I don't want to shake your hand anymore. Yeah, but so that I thought that was interesting, and I guess that kind of rounds out the week of news. Should we get into talking about real estate versus stocks? This is, I don't know about you, this is something I get asked about a fair bit.
Yeah.
Which I always struggle answering because I know shit all about real estate. I don't know very much at all.
Yeah.
But yeah, so essentially what we're going to be doing is we're going to kind of break down investing in residential property or passive investing or active investing, and kind of weigh up the pros and cons and which ones come out on top historically and that sort of stuff. So I guess we start with property. And property, there's obviously two things to consider. There's investment property we're talking about. There's rental yield, and then there's capital growth. And overall, these two things with property, it makes property kind of hard to compare because obviously you can have different rental yields in different areas, and obviously property is so dependent on the area that you buy. So even the capital growth can be different depending on what area you buy. So there's always going to be arguments, well, yes, like some area of property or some area that I bought is going to outperform shares by a lot. You could also make the argument that an area that I bought is not going to outperform shares. So I guess the best thing to do is to just take averages. So although it's not ideal, and there are obviously scenarios that swing either way, we've just got to take Australian averages and use gross yields and see where we get. And then obviously with shares, we've got to look at both capital growth and also dividends. And again, we'll take both of those into account with the numbers that we look at, and kind of look at a gross yield overall.
Yeah. Just to be clear, before we're doing this, we've both bought shares for a few years, but neither of us have bought a property.
No.
So it's
a bit biased.
Yeah. I mean, I've studied property investment, so I have a little bit, but I haven't invested in a property yet. So I really don't know the ins and outs of what it would take to go through that entire process because, I mean, I guess we'll get into it, but I mean, with shares, you kind of just, you're not managing it. You're just the owner. Whereas with a property, you're the manager and the owner. So there's more things to consider.
So much stuff to do.
Yeah.
And we'll try and get past our bias anyway by trying to be quite objective about how we approach the analysis. So if we look at shares, over the past 115 years in Australia, the ASX 500 accumulation index, so that's taking into account capital growth and dividends because it's an accumulation index, the ASX 500 accumulation index has gained 9.95% per annum. And that's an average, a yearly average, so a per annum average for 115 years. So if we talk about averages, that's a pretty good average because it's over a very long period of time.
Lots of cycles.
Lots of cycles. Like that. Everyone always says, like in comments and stuff, but do you account for this time where it was horrible, or do you account for the GFC? But like this, obviously, it's an average. And it's average over 115 years, so it includes everything. Like Great Depression, we're talking like .com bubble, GFC, everything. So it's the best years, the worst years, and everything in between. So. You can look at the long-term average, but then again, you look at like the last 10 years. And this is from research that the ASX did with Russell, who I think just do like ETFs and maybe LICs and stuff like that. I'm not quite sure. But in the last 10 years, Australian shares have not performed that well. They're only averaging, over the last 10 years, a 4% return. Per annum. So,
and you could probably get 2.5%, 3%, probably close to 3% over the past 10 years in a government bond. So you took all that business risk for 1%.
For 1%, exactly. So it's not a crazy return in the last 10 years. And then if you flip it over and look at property, then in the last 10 years, property in Australia, residential investment property has done really well. You're getting like 8% returns per annum. So if you look at the last 10 years, then you're going to see that property has won. However, then if we talk about extending the time frame back even further, so if we look at across the last 20 years, the numbers actually get a bit different. So if we go across the averages over the last 20 years, then we see that Australian shares have returned about 8.8% per annum, and the Australian residential property has returned 10.2%. So a bit better on both, but still property wins, I guess.
Yeah, I mean, properties have just been really hot especially around Sydney and Melbourne. Over the past, I would even say 5 years has just been crazy. Everyone is complaining about house prices.
Yeah, I know. I'll complain about them if you want. Let's start complaining. No, let's not complain. But yeah, you're right. Last, I don't even know how long, but it's just been a constant uptrend. So many people getting annoyed with housing affordability. But I should say with those numbers, that the numbers I just said, 8.8% and the 10.2% over the last 20 years, that's a gross return. So that actually also studied the returns you get after tax at the lowest marginal tax rate. And Aussie shares got 8.8% over the last 20 years, and residential real estate got pegged down to 8.9%.
So a lot of fees associated, a lot of tax associated with property.
And then if you take it to the highest marginal tax rate, then Aussie shares get pegged down to 6.7%, and property held up at 7.6%.
Okay.
So differences obviously, so you can see there's not like just a straight black and white answer. It obviously depends on your own position and what tax category you fall into and that sort of stuff. But overall, if you're looking, over the last 20 years, it probably looks like property might have the edge. But if you look like over the last 115 years and you take that average from the stock market, it seems like might be more or less quite similar.
The general gist is that they're quite similar. And we don't have really any idea, because we're not going to invest for 100 years. Or it's probably, it's probably unlikely.
Charlie Munger could, far out. Almost.
He's always going to be there. He started like 4 or something?
I don't know. Well, if he started at 20, he's still had like 75 years of compounding. That's crazy.
No wonder he's rich.
No wonder. I mean, you start with like a cent and in
Yeah.
75 years of compounding, you'd be all right.
Yeah, but I mean, I guess we're probably gonna be investing over maybe 40 or 50 years.
Yeah.
If you're gonna do it over your lifetime, so we really don't know which one is gonna outperform. As we just saw, like over the 100 years, property shares had it a little bit.
Yeah.
But over 20 years, which is a fair chunk of time still. Oh wait, did property still lose over 20 years?
It's about the same. It depends on what your situation, that sort of stuff. Maybe property has a little edge, but it's like only by like 1% or something. So
yeah, makes sense. So what have we got next?
So we got to talk about. So yeah, sure, okay. So maybe in the long run, okay, maybe it is. Let's say it's property by like 1 or 2% or something. But that's not like the end of the story, obviously, because from my perspective, one method of investing is really simple, and then one is not so simple. And when I say simple, like we're talking passive investing, right? So we're not talking when we talk about the return of Australian shares, this is obviously an average. So we're not talking like trying to pick and choose individual stocks and having to research. We're literally talking like diversified, tracking the market and seeing how we go.
Yeah.
So when we talk about practicality of shares, to get the 10% return per annum over the very, very long term, then all you have to do is like make a brokerage account, find a market tracking ETF, and then just dollar cost average, just like continue to invest across a long period of time. And that will literally, like, it might not happen straight away, but over the very long term, you're going to average out to that average return.
Yeah.
So it's very easy. And that's what I think. If you're just someone who doesn't care and just wants to get rich, this is probably, I would say this is the easiest method. I don't know. What do you reckon?
Yeah, I think it's very easy. I think it looks very easy on paper. I'll just play devil's advocate for a second here.
Go for it.
And
I disagree.
I disagree. But because it is so easy to get in and out of shares so quickly, it can lead people to make emotional errors.
That's true.
That you can't make in property.
Yeah.
I mean, if you buy a property and your neighbor's property sells for 10% less, you're not going onto your brokerage account and selling it.
Yeah,
and
true.
There's no option because the fees would cost you more than you would have lost. So there would be no reason to sell it, which gives you more of a long-term incentive because you can't be nimble. And for that reason, I think shares definitely in theory, and if played out rationally, if, like you said, if you just invest consistently over a very long time, you don't take it out, you don't try and time the market, it is definitely easier and the best way to make a double-digit, well, likely close to a double-digit return over the long term. But I think a lot of people see it that way and they can get into it and they get in the trap of trying to get in and out, and it costs them a lot. That's playing devil advocate there.
No, well, it's true.
It is true.
Bit of foreshadowing too for the videos we're going to record later on as well.
Yes.
You guys will see those.
Like and subscribe.
like, share, fave, subscribe, follow us on Instagram, everywhere else. But I think you're right. And I guess because it's so easy and so quick, you can also get obviously the market can be very volatile. Like a property market, it'll take, you can have a property crash and it'll still take a fair amount of time for that to happen. Whereas you could, or unless it's 2008 where things just see you later. But shares, you could come back and your shares would be worth 30% less tomorrow. If things really go bad. Whereas in property, I guess it'd take a little while. Sure, it might go down by 30%, but it'd take a longer amount of time. Yeah,
I mean, the time that you get in probably has more of an impact in shares because, I mean, if you pick the top, you could lose a lot quickly, and then your return is going to be dramatically different to someone who bought, say, a month later or 2 months later. I guess that's just less likely in property because it's a lot less volatile. So it's more likely that if you buy it today in 2 months, the price is going to be fairly similar. Unless, of course, you're in America 2008 and you lost 70% of value in your house. Some of them went down 70%. I was watching I was watching one of Graham Stephan's videos on the properties that he bought around that time. And some of them were 70% discount to a year ago, like the year before. So he was able to pick up some good deals. It's
crazy that you see... I'm not saying that Graham's not awesome or anything like that, but you see, a lot of the guys that are doing really well that you see on the internet, they all started around 2008, 2009. So it's it even shows you, it is about those entry exits and just, for us, individual stock investing, just waiting for those margins of safety and stuff like that. But
you really don't recognize the importance of patiently waiting in cash for real opportunities if you're just investing in a bull run. Because you can invest with a margin of safety, you do well. You invest without a margin of safety, you do well.
Exactly.
You buy garbage, you do well. Unless you pick something that really did poorly over that time as a business, which is not many businesses over the past 10 years. You did very well.
I guess I'm sure you'd get this as well. So many comments of people that don't wait for margin of safety. It's like, oh, okay, sure, you can wait for that next crash, but I'm going to be investing everything because I know I'm going to get 3% by next week or whatever. It's like, well, how sure are you, and how long is that going to last for? And if we come back in 5 years or something and compare our situations, where are we going to be?
Like people saying, waiting on the sideline, you're missing out on you could get in now, and 6 months later you could get out and you could make a profit, and it's like. I could, but there's a lot of risk associated with that. There's a big risk that I think no one's sort of had the consequence of for a very long time. And one day, 1 month, 2 months, there will be a big consequence for people who are using that method and just sort of trying to ride the waves.
Just buy whatever, momentum investors.
It was like that Bitcoin. I'm not sure how involved you were with that, but a lot of my friends were getting involved with it. Oh,
serious?
And it was around the time that I was just getting really into the Benjamin Graham style of investing. Right. So I was like, guys...
You're like, this is horrible.
I just read this book from 1940 and I know you shouldn't buy it. And a lot of them, they were making a lot of money. In I can't remember when it was. Must have been late 2016.
I don't know. Around there. Hitting that ramp.
And then when it crashed, they stopped talking about it. It was strange. I was like, "How's your Bitcoin going?" Like, "Oh, yeah, it's all right. Down $7,000."
Isn't it interesting how little comments you get on YouTube now about Bitcoin?
Oh yeah, it's insane.
Poor old Bitcoin. I feel sorry for people, but at the same time, like if you're buying a thing that produces no cash for 21,000 Australian dollars, then you got to have a screw loose.
It is. It's a very strange, because even when it's going up, I felt myself. You feel it, let's just buy one.
Let's do it.
Let's just buy a little bit.
Let's buy 0.1.
Because what if it does go to $1 million? It's just that bit. It's just a human instinct, I think, to just want to jump in on it. And I think the price that I was probably the closest to investing in it from that part of me that was just I just want to have a little bit. It was probably around 10,000 Australian, and then what did it go to 20, and then it crashed. So I would have been up for maybe a month, and then I would have lost 90% or something.
It's crazy how much it's gone down. Anyway, back on track.
Yes.
So that rounds out us talking about how easy it is to buy shares. So shares. Hamish brings up good points. Overall, it is very simple to get into, but that obviously comes with its own risks. And then we talk about the practicality of property, and this is where things really get a bit interesting, because obviously property, you have to go through the process of buying. So from the outset, you've got obviously a 50% chance that you're in an area and you've got a property that will beat the market, and you've got a 50% chance that you'll be in an area or rental yield or whatever that won't beat the market, because you're not taking an average unless you do go for something like a real estate investment trust or something, like a massive portfolio of property. But if you're just picking one place, one house, then straight off the bat you've got 50-50 whether you're going to beat or not beat the market. Whereas if you're investing in market tracking ETFs, you're going to get the market return, whether that's positive or negative, but you're going to get it. So it's impossible to really, if you're just buying one house, it's impossible to know whether you are going to kind of do better or worse than the market. At least I don't know how to do it. Maybe there is a way. I don't know. It'd be hard. It'd be like anything. It's like trying to tell whether your stock that you just picked is going to go up or down tomorrow.
It would be more closer to buying an individual business. I mean, you have to do more research about the area. Is it going to develop or not? How many people are going to be living there? There's a lot more factors that come into picking a specific product, in the same way that there's a lot of other factors that come into picking a specific business to invest in.
And then you get into, with property, then you get into that next phase. Okay, sure. So you've gotten past the hurdle of buying a place, and then it's an investment property, so you're not living there. You've got to make sure that people are always in there so that you're always earning money. I mean, I don't have to worry about that with an individual stock or something that, I've got to make sure that the company's still making money today. But yeah, so you've got to manage the property, or if you get a property manager, then you've got to get them to manage the property. And then you've got to, make sure there's always a tenant in there, there's maintenance. I mean, if the toilet breaks or something, then you got to, I don't know, go out there the next day and try and fix it or get someone to fix it. I mean, it's just a lot more hands-on.
Yeah. You absolutely have more of you have an managerial role. Whether or not you have a property manager or not, it's still you still have debt. So you're managing a balance sheet. You've got your property manager that you're managing. You've got the tenants. I mean, they could be good, they could be bad. I'm going to bring him up again, but Graham Stephan, he talked about one time he had this horrible tenant. Oh, really? And he couldn't get them out.
Oh, serious?
And I think it was one of his first properties, and he was really worried about the property. I think he found out that they had a grow house in the garage or something. Out. Yeah, because there was all lights, like wiring set up.
Yeah.
But that's a nightmare scenario, obviously. But there's all these other things that can happen that you just don't need to worry about when you're buying shares, because you should worry about the management. But it's more trusting them to make the right decisions and than doing it yourself.
Yeah, and then when it comes time to sell, it takes a decent amount of time too. So that's another process, is that obviously we were talking about with shares, if you need to sell, you can just sell it. I mean, the liquidity is amazing. But when it comes to property, it's going to take time. So if you need to access that money, you won't be able to straight away. You have to go through that process of selling. You can't sell your property portfolio in 5 minutes. Whereas if I wanted to, I could go on and sell my entire, every stock I own in 5 minutes, right?
Yeah.
So,
and sort of just to go back to what I was talking about where I was playing devil's advocate, the flip side of that is that it could be a positive if you're a really emotional investor and you really don't think that you could stay rational in the stock market, then a property would allow you to stay a lot less emotional, because you can't sell a property on an emotional sort of rage or
it costs you money to sell.
It does. It costs you a lot of money. Yeah. There's a lot of things that are factored into it.
Yeah.
You're probably going through your bank. They're probably going to... there's a huge process there where you wouldn't be you wouldn't have that instinct to just click sell and just sort of panic sell and move into another stock or something like that. So there is that benefit.
So that's kind of I suppose, the practicality side of buying shares and buying property, and also some of the issues behind that. And another thing we should talk about, I'd be interested to hear your perspective on this, is the topic of leverage. So what do you reckon about leverage, first of all?
Yeah, so obviously if you're investing in shares, you're probably not using debt.
Yeah.
Some people do use margin accounts. It's probably not recommended.
I think most people wouldn't. If you looked at everyone that invests, individual investors, I would say most people wouldn't.
Yeah, the interest on a margin account can be more than 10%.
Yeah.
So you really do have to make massive returns in order to cover that interest rate anyway. So most people in the stock market are not using debt, but in the property market, most people are using debt. And there's some sort of added risks that come along with that. The way I like to think of debt is either as an amplifier or as gasoline on a fire.
Yeah. Well, it's an amplifier in both directions.
Yes,
yes.
Be. So if you have a high return investment, having more money to throw into that investment is going to increase the amount of... It's not going to increase the percentage return, but it will increase the total amount that you can make from that. Sort of like if you put a relatively safe amount of gasoline on a fire, it's going to be a lot bigger.
This is like what Sven was saying, where he said how he purchased his property. Do you remember him talking about that? No, he was saying how he bought his property in the Netherlands.
Yeah.
And he was pretty much, he had to put no money down.
That's
and
right.
He could get a
103% loan.
Yeah. Exactly right.
That's right.
So he's obviously there's none of his actual capital in there at all. So he's just running straight off the bank's money.
Yeah. And the benefit of that is that if you don't have money or you don't have enough money, you can get money to put into a good investment.
Yeah.
But of course it amplifies in both directions. As you just said.
So if he wasn't strong financially and the property market went down, something like that could really screw you over.
Yeah. It can really hurt you having debt. It's why when we're investing in stocks, we look for companies with low amounts of debt, because debt is good if there is safe investments to use that money to, and you have plenty of well, for the company it'd be profit, and for an individual it'd be you have enough income to cover those interest payments and be safe in the worst case scenario. But you definitely, like gasoline on a fire, it can make it go out of control. And you don't want to be in the position where you have too much debt to the point where your interest payments are very close to or even above your income, to the point where you're trying to just stay afloat. And that's just another added risk with property, is that you're almost always going to be using debt. I mean, I've heard Graham Stephan talk about properties in America being $50,000, $100,000, but that's just not a reality in the major cities here, at least. I mean, in Melbourne, you go an hour out of the city and it's still over $500,000 a property. And I don't know about you, but I don't have $500,000.
No, I wish I did, but maybe if the stock market crashed tomorrow, in 10 years we might have something like that. But so it's like leverage. Everyone's got their own opinion of it, so we're not going to say it's a positive or a negative, but it's definitely a difference between most people when it comes to shares, or when it comes to property. And did you want to talk about, you've written a bit about market inefficiency as well, so I'll let you take that, because I don't know what you're going to talk about.
So this is something interesting I never really thought about until I studied this at university, when I studied property investment. And that's market inefficiency. So you hear a lot, sort of this debate in the stock market of whether or not the market is efficient or whether it's inefficient. And basically the debate is, if it's efficient, it means that at all times the price of a stock is its intrinsic value, and therefore you can't buy stocks and outperform the market. That would be a completely efficient market. Now, I'm not sure anyone advocates that the market is... maybe some people do. Most people would say it's at least a little bit inefficient, but it's probably quite efficient. And the reason that it is, the stock market is quite efficient, is because there's a massive amount of information available instantly when events happen. And there's, like you were talking about before, liquidity. It's very easy to get in and out of shares. So stock prices can change quickly. So if there's going to be an acquisition for $4 per share and the stock is $3.50 per share, the stock's going to go quickly to just below $4 per share, because it just makes sense. But in terms of property, there is a little bit more inefficiency. So the first inefficiency is that it's not liquid. It takes a lot longer to sell a property, and for that reason, there's not a quick change in the price to adapt for particular changes in the value of properties.
So it's like going to be overpriced for longer or underpriced for a longer period of time.
Exactly. It just takes a lot longer for that change to happen. And the second reason is that in the stock market, everyone is investors, whereas in the property market, you have investors and you have people just buying houses.
That's true.
So what you sort of get is you get these positions where you have a house and maybe just the interior design is from the 60s or the 80s and it's run down. And a lot of people, when they just buy their first property, especially as young people, they just want to move into a house and not think about anything, at least for a while. They don't want to do any renovations for a while. They just want to move in and have a nice house. So for that reason, there's usually there is a little bit less demand for properties that have worse interior designs, older interior designs, even though it might only cost $10,000 to fix. And that's another inefficiency that sort of property investors can exploit, that share market investors, there's no option there. I mean, the equivalent sort of I thought of would be is if you did a sort of Carl Icahn move where you buy the whole company and you strip out the management, you delete, you sell some products, you change everything up, and then you can sell it again, or it's producing more income. In the same way, as a property investor, you can buy a property with poor interior design. You can fix it up. You could either sell it for more, or you could increase the rent. And sort of that's just another inefficiency that I'd never thought of before.
I hadn't.
When I studied that, and I thought that was quite interesting. And the tutor, the lecturer was sort of because he was a property investor, and he was saying that it's a lot easier to make abnormal returns if you know what you're doing in the property market.
It's interesting, the dynamic of having people that are investors but also people that aren't investors, because you're right, there's no one that's buying a stock that isn't an investor, where there are definitely people that just buy houses to live in them. So interesting. Should we compare to active investing? Should we get onto that?
I
reckon so. So we've talked all up until now, with all those numbers we were using, we were talking about passive investing, so just tracking the whole market. and taking averages, and then we were comparing that to property averages as well. But obviously, if you follow the stock market for a very long time, maybe you'll get around a 10% return per annum. You'll average out to that, but you can also earn a bit more, which is what we try and do. So if we compare property to active investing, I think in this instance, I suppose there would be an active investing equivalent to property as well. But if we just compare active investing, classic Buffett, Munger, Phil Town, Monish Prabrai, those guys, where they look for really solid businesses that they can understand. They look for management teams that are trustworthy. They look for companies that have great moats, and then most importantly, they only buy with a margin of safety. There's no reason why you can't get more than a 10% return investing in individual businesses. If you take the time, obviously, to make sure that you know the company inside out and you know it's a good investment. So while it might look like, just if we look at averages, property, maybe it comes out on top by a little bit, you can still definitely be an active investor, and you could, I reckon anybody with a fair amount of effort could beat the stock market, because so much of the way the stock market moves is dependent on the big guys, and the big guys aren't investing the same way that we are. So I feel like you can definitely find, using the value investing approaches, you can definitely get more than just a market return. Yeah,
I mean, I hear a comment I get a few times when I talk about active investing and why people should, if they're interested in businesses, they should go for it. Because they can easily beat the market. And the common comment I'll get is 95% of active investors don't beat the market. And the way I look at it is that stat is only relevant if you were rolling a dice and you've got a 5% chance, but you're not outside. It's not like you're rolling a dice. You have an influence on how you invest, what you invest in.
Exactly.
And that
different
means
strategies.
Absolutely. And that means that there's going to be a significant amount of people in the market. Institutional investors, which represent people who really don't know what they're doing, so they're just giving money. And a lot of other retail investors who are just chucking money at it because they've heard that it's good.
It includes everyone that tries to pick a stock.
Yes.
And I know some people that have tried to pick a stock.
I know a lot of people.
They pick it because they heard some guy on the bus say you should buy this company. Or, I don't know, flipping some person on TV bought it, so I'll buy it.
Yeah.
So, everybody.
Yeah. I mean, you don't see the stat of the people who spend 20 or 30 years learning how to properly invest in businesses in terms of analyzing their cash flow and working out how much are you paying, what is your outflow for the inflows that you're going to get over the next 10 years.
Yeah.
And I'd love to see that stat. It would probably be a lot better than 95%, I would tell you. There'd still be, of course, there's people who attempt to it, and it's just, not everyone's going to succeed at it.
Yeah.
But the odds of you succeeding at active investing, if you have the right strategies, I think is a lot higher than that number. And I think a lot more people, like you say, I think if you have the right strategy and you're consistently willing to learn and expand your knowledge and understand more about the businesses that you're investing in, I don't see why you couldn't at least get it close to market average.
Yeah.
And the other,
I really think you could. You could definitely beat it.
Oh, absolutely. Yeah. And the other point is that it's fun.
Yeah.
I mean,
for some.
But true. Okay.
It is fun, especially if you stick circle of competence and that sort of stuff. If you only look into businesses you care about, then of course it's going to be fun.
Like if I had a significant amount of money in 3-4 businesses that I really liked, that I absolutely loved, and then I matched the market average over the long term or even underperformed it by a couple of %, I'd honestly be happier.
It'd be good. Yeah.
Because there's other things than just the return. Obviously, the return's the main thing of investing, but there's other things. There's where you're going to put your money in. Are you passionate about where your money's going? Are you buying oil companies?
Exactly. Well, that's the thing. In Australia, if you're buying the market, you are buying into coal companies. You're buying...
And finance.
Yeah, finance. Yeah. People doing dodgy stuff, as we've found out in the last year or so. You're buying into everything, but some of the everything is pretty unethical. Well, obviously ethics depends on what your ethics are. Yeah, exactly right. But from my perspective anyway, things that I wouldn't like to back, things like a coal company.
Yeah.
I'm all for trying to solve climate change. So I flipping hate coal companies. But if I just track the market, I'm going to buy a coal company.
Yep.
And like BHP, and they drill oil and that sort of stuff. So Whereas if I want to invest in individual businesses, I can pick the ones that I care about, and maybe it's something like a Tesla or a Facebook or just all those companies that I bump into and I really like, and that's where I want to put my money. So yeah, you're right. You're right. Should we get into some Q&A to finish off? That kind of rounds out. I think that pretty well rounds out property versus real estate. What do you reckon?
Yeah, I think that was a good discussion.
Closing remarks.
Overall,
buy
stocks.
Buy stock. Yeah.
No,
we are biased.
Yeah, we are biased.
Well, I mean, it's just I reckon we've explained both sides of the coin pretty well.
Yeah.
I think it makes sense. Like, there are pros and cons for both. Stocks are easier, as you're saying. That makes it a little bit iffier with emotional investors. But yeah, overall, maybe property has the edge over the last 10, 20 years. But over the long run, if you're someone that just wants to passively invest and go to sleep and wake up in 50, 60 years with more money than you started with, then maybe it's easier just to go with stocks. All right. Let's hit up this first. So this first question is there a way to work out a fair value for an ETF, or is there just no way to do this because it covers a broad sector? What do you reckon?
Yeah. So I had a bit of a think about this.
Yeah.
So I guess in theory, the best way to do it would be you're basically comparing the price that you're paying for the ETF for all of the businesses to the cash flows that all of the businesses produce.
Yeah.
And while you could do this by using market estimates of growth rates and sort of taking an average of how companies, what cash a company is going to produce, I think that it's not something that would be worth doing. I mean, Benjamin Graham does talk about in his book how there are times where he would say, don't dollar cost average, actually wait for a crash. He actually says that.
True.
Like, what does he say? He says something along the lines of an intelligent investor who is rational could do it, but most people would probably struggle to do it correctly. So I think the best option is just to dollar cost average. You don't need to worry about any of that if you're investing in an ETF. You can just save up a few $1,000s every month and invest it. And that will do you very well over the long term.
Yeah, I'd agree.
And I mean, if there's complete dire straits in the market, like the news is terrible, market's down like 50% from its top, then you could put in a little bit more.
Yeah.
I mean, there's no harm in putting in more when the price is a little bit lower relative to the earnings.
Yeah.
But to try and do it consistently, I think it's very difficult to do. I think it's a lot easier to do with an individual business where you can look at the business, how many units are they going to sell in the next 10 years and do it that way. And
with things like, for instance, like a listed investment company, people like to look at what's called the net asset value, because sometimes the listed investment company their stock price trades a little bit below the net asset value, which some people will tell you makes it cheap and that sort of stuff. With ETFs, their price doesn't tend to stray very far at all from that asset value. So, for me, like, I'm only looking at market tracking ETFs. I'm not looking at sector ETFs or resource ETFs or anything like that. I just want to track the market. So you could maybe argue that's a way, something to consider if you're trying to value an ETF is maybe looking at some of those like broader market indicators like a GDP to total stock market index or ratio or something like that, or something like your Schiller PE and that sort of stuff. But overall, I'm not in the game of trying to figure out exactly what I should be paying for my shares in some ETF. I feel like, like what you're saying, you could take into account the cash flows of all the business. I feel like that'd be very hard. But overall, if I'm like, I save the valuation stuff for individual businesses. I mean, I'm with you. I reckon the best way, for me anyway, to go about ETF investing is click a button every 6 months and keep coming back and keep doing it every 6 months. Because the benefit of ETFs is that they're tracking the market. And we know that the market goes up in the long run. So why do you want to mess around with that? Just try and dollar cost average and get the return that it says on the sticker, I guess. Yeah.
Couldn't agree more. All right, so the next question we've got is, do you have a checklist before you buy a stock? And if so, what's on it? Brandon, what's on it?
I don't know if I have a checklist. Well, I just have the checklist, like the classic 4 pillars of value investing kind of checklist. I don't have like things that that I put like more weight in or less weight. So I think my checklist is obviously the company's got to have some sort of meaning to me. I've got to be able to understand the business. It's got to have a moat. It's got to have good management. It's got to be at a margin of safety price. And I feel like that's Obviously, all four of those pillars are a must, because all four of those pillars can destroy an investment. You can have 3 greens and 1 red out of those 4, and your investment is ruined. It can be ruined because it might be a great business with a great moat and a great management team. If you buy it too high, it's a bad investment. It could be at a great price, it can have a moat, it can be good meaning to you, but the management team's terrible, and it can destroy your investment. So I think they're the 4 pillars that you have to have before you invest in an individual business. I think I really like the return on invested capital. I feel like I look at the return on invested capital a lot. I really focus, I didn't used to, but I really focus on management teams now.
Yes.
Because I feel like even if the company, say, you can look at the moat and the moat numbers and that sort of stuff, but even if a company has a kind of couple of weak years, if you have a really strong management team, they're going to be able to dig that company out of the problem that they're in. So I kind of put management first, I guess.
Management is a very vital one, especially because we're going to be investing when there's maybe 1 year or 6 months of negativity. And you're going to be hearing all about that from the management. And if you have high confidence in the management and they say, yeah, we'll be sweet going 2020 and beyond, or 2021 and beyond, we'll be good. We just have to restructure some things and have some short-term costs. Then that's going to give you the confidence to invest in it. So I think I agree with you there. Management skill and their integrity are those 2 things. I guess I'm the same as you. We have the same checklist of the 4 things that we look for, but there's nothing specific in there that has to be like a green or red light. It's not like if they have this particular debt ratio, I'm not investing in it. It's more subjective when it gets down to the lower levels of that. And like the moat, there's not a checklist I go through. Yep, it has a moat. There's no data that sort of, there is some data, but it's not entirely data. There's a fair bit of my just general opinion of whether or not it has a moat.
Qualitative stuff.
Yeah. And I think that's the last Q&A question that we've got. So that sort of wraps us up for this.
It does.
It does,
It was good. It was a good podcast. I enjoyed that.
Yeah.
It was a lot of fun. Man, if only we could do it live every week. That's the number one bit of feedback we get is, you guys should do it live and have it recorded and videoed and stuff. And it's just man, file sizes and Australian internet and it's just very...
There's no way we could do it over the internet.
So impractical.
Yeah, hopefully one day we can get a studio set up going.
That'd be mad.
I think that would be really cool.
When this place goes bankrupt, we'll
just buy it.
Yeah, we'll just buy it. Why not?
Yeah.
No, that's good. Thanks guys for submitting your questions. As always, if you do have a question that you want us to answer, make sure you leave it down in the comment section of the YouTube video. And if you're not watching this on YouTube, you should, because we are live and we've got video and it looks awesome and we've got to a lot of effort to do this. So please go and watch it on YouTube. But of course the podcast is also on Spotify and iTunes and all those nice places. But that was pretty good.
That's a wrap.
Yeah, that is a wrap. Thanks for joining us, guys, and we'll see you guys in the next episode.
See you later, guys.